Hi class. In this video we're going to look at a couple of examples that are similar to the homework for chapter 13. So this one says on December 31st, 2019, the income statement section of the worksheet for Cappelletti Distributors contains the following information. And we've got a list of account balances, and then it says the owner of the firm is John Cappelletti, and his drawing account has a balance of $26,350, and that's at the end of the year. Excuse me. So it says prepare the entries that should be made in the general journal to close the revenue, cost of goods sold, expense, and other temporary accounts. So we've got 4 entries we have to make in this. And so if you recall, we've done closing entries before, and there are 4 that we need to do. And the first one in the past we've done was close our revenue accounts. The second was close the expense accounts. The third one was close income summary. And then the fourth one was to close the drawing account. Now, this example is similar to that, except for we have some other accounts that are also temporary accounts that are not either revenue or expense. For example, we have a revenue account of sales, which we've closed in the past. But this time we have a sales returns and allowances and sales discounts. And those are a couple of accounts we're going to close that we haven't closed in the past. So let's just walk through these. The first entry, we're going to close revenue and other credit items, so that's fairly explanatory. So you're going to start with the sales account, which is a credit account, and then here we have another income account, which is interest income, and then we have purchase returns and allowances and purchase discounts, and those two fall in that other credit items. So we've actually got 4. So if they have a credit, then we're going to debit them to get rid of them. So we've got sales and what's it? Interest income, purchase returns and allowances, and purchase discounts, I think is the 4. Yeah. And you're just going to bring those amounts down. So $256,000 for sales. It was $185 for interest, $21.50 and $15.60. And all of those get closed into income summary. So we've got to add those up. So let me do that. It's like $259,895. So that's entry number 1. Entry number 2, we're going to close the expenses, but in this chapter we're also dealing with some other debit items that are temporary accounts that we need to close. So again, we're going to scroll up to our chart and look at our debit items, and you can ignore income summary for right now. So we've got sales return allowances and sales discounts, and purchases and freight in. So those 4 are items that we haven't closed out in the past, but that we'll need to close out now because we're dealing with a merchandising business. And then we have all of our regular expenses. So there's a ton of them. And those all get closed out to income summary. And since they are debit items, they get credited. And lucky me, we're going to do some scrolling here. Got sales returns and allowances, sales discounts, purchases and freight in, and all of those expenses. Let's see, rent, utilities, telephone, salary. Payroll taxes, supplies, depreciation, and interest. And then we have to take all those amounts and bring them down. So just bear with me for just a minute while we do that. Oh, we're getting there. And one more. Interest is $370. Oops. All right. And then those are all our credits. So then we're going to debit the total of those. But let me make sure I typed them all in before I add them up. And it looks like I did. So let's add all those up. And hopefully I added those right. I got $225,995. Let's make sure. Nope, evidently I can't add today. Let's try that again. Maybe second time's the charm. 233,780. Let's try that. Much better. All right, so that's our first and our second closing entry. The third closing entry is to close income summary. And this time when we're going to close income summary, we have to pay attention to income summary because it already has some balances in it, and that wasn't the case back in chapter 5, 6, back wherever we did these closing entries before. So we have an income summary. It has a debit and a credit, and we have a credit here that we added to that and a debit here. So we're going to have to add the debits, add the credits, and take the difference, just to kind of pretend like you have a T account you're working with. So give me just a second to add and subtract those. And I think if I did my math right, which seems to be a little bit iffy today, I get a credit balance in my income summary of $29,415. So to get rid of that credit balance, I'm going to debit. And of course, when we close out income summary, it goes into the capital account. And let me check and make sure that I got those amounts right. Yeah, so that should be, here's your closing out your sales and other credit items, closing out your expenses and other debit items, and then we closed out our income summary. And then the last one's super easy. We've done those before. You're just going to close out your drawing. And I think they told us what that was. Yeah, I had a balance of $26,350. So drawing normally has a debit balance. So to get rid of a debit balance, we're going to credit, and it gets closed out into capital. And it was $26,350. So that's going to look like that. All right, so that's question number 1. I'm going to look at this one just real quick. I'm not going to walk through them, but we have some adjusting entries. And this says examine the above adjusting entries and determine which ones should be reversed. So the thing that you're going to look for reversing entries are adjusting entries that have a receivable or a payable in them. So basically you want to look through here and find any of these entries that one side of the entry was either some kind of payable or some kind of receivable. The rest of them, you just leave them. You don't need to reverse those, just payables and receivables. All right, let's see what the next one looks like. This was a long one. So we've got a classified income statement, a statement of owner's equity, a balance sheet, and then there's an analyzed. So we'll work through part of this. It says Superior Hardware Company distributes hardwood products to small furniture manufacturers. The adjusted trial balance data given below, and this is in the worksheet. So these are the balances for everything, all of the accounts. So we just need to figure out which ones go on which financial statements. So they're in order: assets first, then liabilities, then equity, then revenue and expenses. So I always like to look down in here and find my sales amount, because that's a really good benchmark to kind of know where the start of the income statement is. So if you can find your sales, then everything below that should be on your income statement. So that's just a good place to start. So we've got kind of a template down here. So we've got to fill in the blanks. So we've got sales is what we start with, if I can find it. And then we're going to take out our returns and allowances. So 1,671,000. We're going to take out returns and allowances, $17,500. Oops. So our net sales is just the difference between those two things. Which is $1,653,500. And then we've got our cost of goods sold section. So we've got our merchandise inventory on January the 1st. And then we have some purchases. We've got some purchase returns and allowances and some purchases discounts. All right. So in this section of the worksheet, this section comes after the adjustments. And one of the adjustments we would have done would be to our merchandise inventory. So the merchandise inventory that we see here, the $227,000, that's actually the merchandise inventory at the end of the year. And we need the merchandise inventory at the beginning of the year. But if you recall, when you're closing out merchandise inventory, you're going to close that out to income summary. So let's find income summary. And it's all the way down here. So you see this $227,000, it's up here. And it's down here. That's where we put that ending inventory into merchandise inventory. So if this is the ending inventory, the $227,000, the first thing we did when we adjusted our merchandise inventory was we took out the beginning of the year balance, which is right here. So that $237,000 that's in income summary is actually the beginning inventory. And the rest of it you can just pull pull off of this information. So we've got purchases of $760,000. Purchase returns and allowances of $77.40, and purchase discounts of $10,460. And it looks like it added these things up to give us a delivered cost of purchases. Except for, I bet it's wanting a minus here because it's adding those up. So let's try that. Oh, I think I got too many sevens in there. There. All right. Let's make sure we got that right. That's the funny thing about Connect. Sometimes it's quirky. Let's try to flip-flop them and see if that works. Let's try this again. Well, let me look back up here and see if I got the right things. Purchase discounts, $10,460. And purchase returns and allowances was $77.40. All right, this better work. Oh, I missed a whole account there. Freight in. Let's fix this. So my best advice for doing this is to look at the book and follow the template. Let's try this. Purchase returns and allowances. And purchases discounts. We're going to move them down one section. Purchase returns and allowances, purchases discounts, and so we're just going to bring those down. And I'm not sure if it's going to make us put the minuses in or not, but I don't think it will since we're moving them down. I put the wrong amount in there. All right, let's get rid of this one. And that one. And let's put our freight in here. I think that'll fix our problem. It'd help if I paid attention to the chart above. All right, freight in, $13,100. And that should, that should be added to your purchases because that increases the cost of the purchases. So there's our purchases and our freight in. And then we're going to subtract down here the purchase returns and allowances and purchase discounts, and that'll give us the net delivered cost of purchases. And let's make sure that Connect is happy with these before we go on. So it should look something like that. So the total merchandise for sale is the beginning merchandise inventory plus the purchases less basically the stuff we sent back in the discounts. So let's go back to our worksheet. So we've got merchandise available for sale, but we didn't sell all of it. We still have some merchandise left, and that's our merchandise inventory. That's the ending, which is the $227,000. So we're going to subtract that. Oops. All right, so there's our gross profit. And I think this blank should just be, actually is a blank. Well, let's see. Oh, there's our cost of goods sold. See, we have there we go. So there's our cost of goods sold and added that for us. It put the gross profit in there. So then we've got our our operating expenses, and they are broken out into warehouse expenses, selling expenses, and general administrative expenses. And I believe they're kind of in order up here. So we've gotten all the way down to purchases discounts. So warehouse expenses, pretty much the ones that say warehouse. We've got warehouse wages, warehouse supplies, and warehouse equipment depreciation. So it looks like there's 3 of those. Where's warehouse wages and warehouse supplies and warehouse depreciation. Oops, that shouldn't be accumulated depreciation. It should be just depreciation. There. And let's plug each of those in. All right. And if I remember correctly, there's actually just a blank line that's an extra line. I think that's all the warehouse. Then we've got selling expenses, and there's a sales expense. Travel and entertainment is actually considered a selling expense, as is delivery wages expense. Delivery expense is something that the business incurs to deliver the items, and that's kind of a perk of buying with the business, so we consider that a selling expense. And then the depreciation on delivery equipment is also selling. So for selling, we've got salaries, travel, delivery, and depreciation. All right, so let's plug in those amounts, and they just come straight from up here. All right, and then it totaled those up, so we've got total selling expenses, and I hope I got those all typed in correctly. And then the rest of them, let's see, we got down to salary expense for office. So from salaries expense office all the way down to depreciation expense office, those are all administrative expenses. Oops, so we've got insurance. Oops. Utilities, telephone, payroll, property, an uncollectible accounts expense, and a couple of different depreciations. With office equipment and building. Oops, and that should not be accumulated depreciation. Clicked on the wrong one. Sorry about that. Should be depreciation expense for office equipment and depreciation expense for building. And then we've got a couple of income items and an income item and an expense item that don't fit in really any category, and so they go at the bottom. So we've got an interest income here and an interest expense down here, and those go in that other category. So our other income would be interest income, and other expenses would be interest expense. All right, so let's see how we're going so far. So most of these amounts, what did I do there? Oh, I just picked up the wrong one, so it's a good thing I checked. That should be warehouse supplies expense instead of just warehouse supplies. So let's see if we can find that one. Yeah, just be careful and don't click on the wrong one. And I think I did it again. Did I? No. And depreciation expense for warehouse looks like I typed in the wrong amount. Oh, 5,100 instead of 51,000. That makes a difference. All right, let's see this again. That looks better. Oops, I have a wrong amount there. I probably have too many zeros. $6,400. Boy, I'm going zero happy today. $6,400. Okay, so I'm not going to plug in all these other expense amounts. You can do that. I think the hard part is knowing where these account titles go, and I did want to at least get through those inventory amounts because they're a little tricky to find. So your beginning inventory and your ending inventory. The ending inventory is the amount in merchandise inventory right here. In the beginning, you have to find an income summary. The rest of it, you can follow an example in the book, which I would recommend. It's just easier to follow a template because it can get kind of convoluted. Remember your net income for the year, which mine's not finished, so that it wouldn't be this, but whatever it is down here, then is going to go to requirement 2, which is your statement of owner's equity. So you're going to have your equity, you're going to add the net income. So up here, you can find equity, and like I said, I always like to find the sales because it's just a good benchmark. To know everything below goes on the income statement, everything above either is balance sheet or statement of owner's equity. So this capital right here, and they've actually got it dated, which is kind of helpful. So that's the amount you're going to start with the statement of owner's equity. In your classified balance sheet, they've got it categorized pretty well, so I don't think you'll have any problems. But remember, you've got some things that are current, some things that are long-term. When you look up here at your worksheet amounts, you should start with cash and everything all the way down to loans payable should be on the balance sheet. And then, of course, this capital stuff that gets closed out in the statement of owner's equity, which then gets carried over. So this stuff here doesn't go on the balance sheet, but everything above. And I think you can pretty much figure out where to go because they've done a really good job having this template split up its current and long term. The one thing that usually trips students up is these prepaid expenses. I think there's 3 in here. Obviously, prepaid insurance is a prepaid expense. But these supplies, they consider a prepaid expense. So warehouse supplies and office supplies also go in that prepaid expense category. And then what does analyze say? Oh, analyze says the current ratio. To get the current ratio, you're going to divide the current assets divided by the current liabilities. So you're going to have to go to your balance sheet, find your total current assets, which should be in this top section, and divide that by the current liabilities, which is down here. And that, whatever that comes up to be, will be your current ratio. So I hope this helps. As always, if you have questions, feel free to give me a call or send me an email, and I will try to help you out.